The market's reaction from the Federal Reserve meeting last week has brought risk to the forefront yet again. We're seeing extension into some big levels after a strong gap down, and now everyone's focused on the headlines. So here's my hot take. The current narrative does not matter as to whether you're going to be profitable in the markets or not. If you've been hiding under an economic rock for the past 18 months, let me go ahead and bring you up to speed first, and then we'll talk about why my hot take is true, okay? So the basic idea is this. The Federal Reserve has embarked upon the fastest rate hike regime in the history of modern finance, and there are multiple second-order effects that have been taking place since then. And it looks like it's about to accelerate. If the Federal Reserve sets the discount window at 5.25%, that puts mortgages at 7.5%. I think we're seeing 8% now. Business lending costs go higher, general cost of capital goes higher, and all of a sudden you're staring down the barrel of a recession if the Fed keeps rates for too high for too long. And the Goldilocks case is that we'll see a soft landing in the economy and that the Fed will be able to back off of its financial tightening without breaking the system. Of course, this is rarely true. The hubris of central banks is that they tend to be behind the curve and not adapt to current market conditions. Great example is 2021. The Fed kept talking about how inflation was transitory. And shocker, they were wrong. And that led to a harsh spike in input costs. Energy products spiked. The risk markets were no longer seeing that kind of fun upside that we saw in early 2021. And then every central bank across the globe woke up and started cranking rates higher. And so far, it's been a pretty tame reaction economically. Commodities pulled back. Jobs numbers look fine. But overall, inflation numbers keep being sticky. And we did have this nasty move earlier this year where the regional banks, they were holding on too much duration risk. In other words, these banks are holding the bag on a bunch of treasuries and mortgage-backed securities at hilariously low rates. And that's how they took out Silicon Valley Bank and First Republic. Those also happen to be the major players in the technology ecosystem out in Silicon Valley. So we really haven't seen those effects pile on just yet. Those debt securities that all these banks hold, and not just the banks, the pension funds, a lot of very large institutional capital, they still technically produce returns. It's just 1% a year. If they're not leveraged, it's not a huge deal, but if you have to sell, it is. The issue is that many of these institutions, they're holding debt instruments where if you were to value them on a mark-to-market basis, they would be in 40 to 50% drawdowns, all right? And this is on credit. This is not supposed to happen. And it's not just US Treasuries. You also have corporate debt. You've got emerging market dollar-denominated debt. You've got other sovereign debt that's in deep drawdowns relative to where they were priced 18 months ago. And so it feels that we're in this weird, quiet place in the market where everyone's just holding their breath to see if the whole thing's about to collapse like a house of cards, and that it doesn't matter what the Federal Reserve does next because the damage has already been done with the rate hikes. And then when you combine that with the resumption of student loans, which is going to be its own version of quantitative tightening, and you have a drastic reset in property tax increases due to values being reassessed higher, and then you get forced sellers on the market, all of a sudden you get these market dynamics that create a lot of instability, a lot of convexity, and quite honest, it could get ugly within the next year, okay? Now, I've put you right to the edge saying, look, it's the financial apocalypse just around the corner. So let me take you and talk you back off that ledge, all right? I didn't start trading full time until 2009, but I was aware of what the markets were doing leading up into that great financial crisis. And first off, I remember when crude oil was hitting triple digits because right after Katrina, I was driving on the interstate, shocked to see gas prices at a whopping $2.75 a gallon. And I also knew back then that there were a lot of people who were not qualified to become real estate investors speculating in the Orlando markets. It felt like a bubble and it turned out to be a bubble, but this was in 2006. The housing market bubble was exceptionally obvious starting in 2006, but the market really didn't roll over for another 18 months. We had another kind of event, Lehman Brothers. I'm pretty sure it was Lehman. Lehman went bankrupt in February of 08. Credit crisis didn't happen until October, November of 2008. All right, it took like 9 months. All right. Now I want to fast forward past the great financial crisis to somewhere around 2011. And this was the point when we had that fiscal cliff risk, market, US government shutdowns. The market took a really hard hit and there was a lot of other nasty news flow coming out. You had European debt markets that were falling off a cliff. We had an acronym for this called PIGS, Portugal, Ireland, Italy, Greece, and Spain. And all of that debt would eventually be monetized by the ECB, but those rates ended up at 9-10% on sovereign debt. You also had escalating geopolitical tensions due to the Arab Spring. There's a lot of noise in the background, right? So a lot of people got bared up and they were looking for that second push to the downside to try and retest the 2009 lows, but that never happened. And if you had been permanently bearish all through the 2010s, that you missed out on one of the best equity markets in the history of finance. So I say all that to say this. If you're going to try and make it in this market, you cannot base your financial decisions on the whims of whatever the headline of the day is. You need a solid trading framework that allows you to profit both on the short side and the long side, and you need a method of structuring your trades so that you maximize the rewards relative to the risk that you take in each trade. And finally, you need to understand your opinion on the market does not matter, okay? Price movement occurs when institutional flow overwhelms one side of the trade and we get a strong move in either direction. We have a trading roadmap that allows you to identify this institutional order flow. And I can tell you right now, at the time of this video, we're starting to see signs in that roadmap that suggest a bounce. Not necessarily a bottom or the bottom, but we're at a point where the reward to the upside relative to the risk to the downside is allowing for some solid trading opportunities. So while everyone else is frozen in fear from reading all of the headlines in financial media about how the Fed's going to break everything, we're basing our decisions off of the internal structure of the market and what the motivations of those institutions are right now. So if you'd like to get an immediate edge in your investing, if you're tired of chasing the headline of the day, then I encourage you to click the link below this video and sign up for our free trading webinar that will show you exactly how we use our trading roadmap to identify key turning points and profitable trading opportunities in the market. Click the link below this video to get started now, and I'll see you on the other side.